Fifth Third Bancorp, stock ticker FIDB, is a diversified regional bank holding company that offers a range of financial services and products such as deposits, lending, transaction processing, and advisory solutions. Founded in 1858, Fifth Third Bancorp is now a $17 billion by market cap regional banking player that employs 19,000 people. Headquartered in Cincinnati, Ohio, the bank is mostly focused on its core Midwestern market that includes the states of Ohio, Michigan, Illinois, and Indiana. With total assets of approximately $210 billion, they are in the top 20 largest banks in the United States. To give that scale some context, there are over 5,000 commercial banks and savings institutions in the U.S. The bank reports results across three segments: consumer and small business banking, 51% of fiscal year 2022 revenue, commercial banking, 48%, and wealth and asset management, 10%. General corporate and other accounted for negative 9%, reconciling the difference. I think it's fair to say that the banking business model isn't what it used to be. A heavy regulatory paradigm, at least in the US, is designed to protect the core structure of US capitalism, but this comes at the heavy cost of severely restricting what banks can do and how fast they can grow. That said, the business model is still quite powerful. It's not by accident that banking dates back to antiquity. Society basically cannot function without the proper flow of capital and the ability to conduct commerce in a reasonably efficient way. It was true thousands of years ago. It's especially true for a free market economy like the US has now. Banks serve a crucial role in capital formation. As a reward, banks build up what's known as a float. That's the low-cost capital that accrues as a natural course of doing business. Banks can and do take advantage of the float, earning a substantial amount of money on deposits. Banks take in capital at one rate, then lend at a higher rate. Furthermore, almost every major bank out there has branched out into different adjacencies that lessen reliance on deposits and dampen some of the regulatory pressure. These adjacencies are often fee-based businesses that take advantage of capital formation, such as asset management. Fifth Third now generates about 1/3 of its revenue through steady fees. Taking what's a really good business model and making it even better is what should set up Fifth Third to continue growing its revenue, profit, and dividend for a long time to come. To date, Fifth Third has increased its dividend for 12 consecutive years. The 10-year dividend growth rate of 13.1% is strong, and it's also been fairly linear. To that point, the most recent dividend raise came in at 10%. Fifth Third has been a lock for double-digit dividend growth over the last decade. Better yet, you're pairing that with the stock's market-smashing yield of 5.1%. It's hard to overstate how incredible and unusual a 5% plus yield on this stock is. For perspective, it's 160 basis points higher than its own 5-year average. This stock tends to offer a pretty appealing yield most of the time, but it's outrageous right now. Price and yield are inversely correlated. The stock's recent plummet, coming on the back of broader concerns over the state of US banks, has caused the yield to rise to this high level. Despite some hysteria, the payout ratio of 37.7% indicates no issues whatsoever with the health of this dividend. It's uncommon to get this kind of yield and dividend growth with a payout ratio this low. We have a pretty spectacular combination here. Looking at business growth, Fifth Third advanced its revenue from $6.3 billion in fiscal year 2013 to $8.4 billion in fiscal year 2022. That's a compound annual growth rate of 3.3%. Decent top-line growth during a very challenging decade for banks. I have no problems with this. Meanwhile, earnings per share grew from $2.02 to $3.35 over this period, which is a compound annual growth rate of 5.8%. Profitability improvement and prolific share buybacks both helped to spur excess bottom line growth. Regarding the buybacks, the outstanding share count is down by 22% over the last 10 years. So how should we feel about this? Well, it's been a tough period. Low interest rates, a muddling economy, and heavy regulations have all conspired to put a lid on what banks can do. Against that kind of backdrop, I'm not disappointed by what Fifth Third has been able to cobble together. I'm actually somewhat inspired by it. I will say the gap between EPS growth and dividend growth is noticeable. That gap will have to close over the coming years, either through higher earnings per share growth or lower dividend growth. Looking forward, CFRA is forecasting a 5% compound annual growth rate for Fifth Third's earnings per share over the next 3 years. I think that's a reasonable expectation for the near term. While I don't see Fifth Third as being in danger from certain idiosyncratic bank failures over the last several months, it will likely be a victim of circumstance. Higher capital requirements and heavier regulations are likely coming for the entire industry as a blanket government response, regardless of an individual bank's health. This makes a tough operating environment even tougher. In addition, issues brewing across commercial real estate, especially in the office building type, only serves to further harm sentiment around banks and bring up questions regarding balance sheet losses. On the other hand, interest rates are higher than they've been in years, driving up NII. Also, the bank has been rapidly expanding across Florida, one of the fastest growing states in the USA, which broadens and improves the bank's geographic footprint. And Fifth Third's conservative nature, including a heavy reliance on steady fees, further insulates the bank from industry woes. I think CFRA does a pretty good job of summing up the whole picture by citing, and I quote, Fifth Third's strong franchise, which we believe is less susceptible to deposit pressures than banks with high levels of uninsured deposits or a lack of diversification in geography or customers. Fifth Third maintains a diversified product set that generates a high level of fees, and we expect Fifth Third to continue to gain market share through its strategy to grow middle market commercial lending, deepen industry verticals, and expand into the faster growing Southeast. On the credit side, Fifth Third is well positioned as it has just 1.3% of its loan portfolio in the struggling office sector versus peers at 2% to 4%. As a result, we don't expect outsized credit losses in upcoming periods, which should help combat funding pressures, unquote. If we take CFRA's number as our near-term base case, that sets up Fifth Third for a similar level of dividend growth. A mid-single-digit dividend growth rate is a far cry from what Fifth Third has been able to do over the last 13 years. However, the market has already sussed this out and adjusted the yield higher in order to compensate for lower near-term dividend growth expectations. That means dividend growth investors are able to lock in a higher yield today while waiting for the dividend growth rate to return to a normalized level. And mid-single-digit dividend growth should be forthcoming until that time. If one does lean a bit more toward yield than growth, that's a pretty compelling setup. Moving over to the balance sheet, Fifth Third has a good financial position. The total assets of $207 billion lines up against $190 billion in total liabilities. The bank has the following investment-grade credit ratings for its senior debt: BBB+ S&P, Baa1 Moody's, and A- Fitch. Profitability is fairly strong for a regional bank. Return on equity has averaged 11.8% over the last 5 years, while net interest margin came in at 3% for the last fiscal year. The industry is challenged, but Fifth Third's favorable geographic footprint, as well as product set that leans into fees, does position the bank relatively well. And the company does benefit from durable competitive advantages that include economies of scale, a large float, sticky deposits, and built-up relationships. Of course, there are risks to consider. Competition, regulation, and litigation are omnipresent risks in every industry. In particular, regulation is a constant thorn for any bank, and this thorn is only getting sharper. The U.S. Federal Reserve has been aggressively increasing interest rates, aiding NII, but rates are actually still low by historical standards. Technology, which makes it easier than ever before to move money, has made bank deposits less sticky. Any bank is susceptible to sudden run on deposits. Fifth Third is directly exposed to economic cycles, and the current cycle is very uncertain. Recessionary risks are always out there, and a recession can hurt a bank in two ways. Less economic activity reduces demand for loans and growth from deposits, while loan losses harm the balance sheet. Losses across commercial real estate are building up, and that can impact the likes of Fifth Third for years to come. I see most of these risks as being pretty common for any regional bank, although Fifth Third is uncommonly good in many ways. Better yet, the valuation also appears to be uncommonly good right now. The price-to-earnings ratio on the stock is sitting at 7.3. That's nearly 1/3 of the broader market's earnings multiple. It's almost as if the bank is being priced for terminal decline, which is the opposite of what's actually happening. Now, banks always get low earnings multiples, but this one is unusually low right now, as the bank's own 5-year average PE ratio is 10.5. The price-to-book ratio of 1.1 is slightly lower than its own 5-year average of 1.2, and the yield, as noted earlier, significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 6%. I'm being conservative here, recognizing that a lot of the last decade's high dividend growth rate was fueled by an expanding payout ratio. When we look at proven earnings per share growth over the last decade, as well as what's expected over the next few years, we're basically right in this mid-single digit range. Now, Fifth Third could certainly surprise to the upside when looking out over the next 5 or so years, and I'd be somewhat taken aback if they don't. But with so much pressure on banks, I'd rather err on the side of caution. The dividend discount model analysis gives me a fair value of $34.98. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates FITB as a 4-star stock with a fair value estimate of $39. CFRE rates FITB as a 4-star buy with a 12-month target price of $35. I came out almost exactly the same as where CFRE landed. Averaging the three numbers out gives us a final valuation of $36.33, which would indicate the stock is possibly 29% undervalued. Here's the bottom line, guys. Fifth Third Bancorp is operating one of the oldest and most powerful business models out there. While the industry is challenged right now, a favorable structure and geographic footprint positions the business really well. With a market-smashing yield, a double-digit long-term dividend growth rate, a moderate payout ratio, more than 10 consecutive years of dividend increases, and the potential that shares are 29% undervalued, income-oriented dividend growth investors who gravitate toward cheapness will want to take a good look at this name. And now for a special news announcement. Broadridge Financial Solutions Inc., stock ticker BR, recently reported a strong Q4 with revenue up 7% year over year. Adjusted earnings per share grew by 21% year over year. We highlighted this high-quality fintech business back in May. Shares are up quite a bit since then, but this business is firing on all cylinders. Don't forget about Broadridge. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and am often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.